All attendees are in listen-only mode.
Testing.
Testing. All right. Good morning, clients and trading reps. Welcome to Phillip Securities Research weekly market outlook. I'm Wei-Wen. Today's agenda would be as usual. We kick off with our market outlook, followed by Ken, who will take you through some of our stock picks, and finally Joshua, who will feature our feature company for this week, which is Penn United. Alright, in terms of this week, the key major risk event that will actually dictate market direction will actually be the FOMC meeting on 19th June, and more specifically it will be 20th June, which is 2 a.m. Singapore time. It's not the FOMC made statement that will garner interest, but more specifically it will be actually Ben Bernanke's press conference, which follows afterwards. Now, essentially, what should investors actually watch out for? There are actually three key points. First, the first thing to watch out for will actually be the Fed's updated assessment on the economic outlook. The second thing to watch out for would be its inflation expectations. And the third thing would be whether will we see continued commitment to actually hold down short-term rates even after tapering begins. Our base case has been tapering should start end of this year or early next year, right? And short-term rates should only start rising towards the mid of next year. Now, another risk event today will actually be also coming from Indonesia, where we could actually expect to see an introduction of the fuel price hike into the budget. We expect headline inflation to actually rise to around 8% year-on-year in second half, and in that context, we took comfort that Bank Indonesia actually proactively managed monetary policy in terms of doing an off-cycle hike to the FASB rate, as well as a 25 basis points hike in policy rate last week in a bid to actually anchor inflation expectations. For the Nikkei, it still remains in a corrective wave. This morning, the Nikkei actually bounced up, but it actually needs to clear above the 13,000 level, psychological level, to actually go higher. Key risk event for the Nikkei will actually be also Kroda's speech this Friday on 21st June, and we wait to see whether Bank of Japan would actually introduce new measures to actually curb the volatility in the Japanese government bonds. For S&P 500, it has been consolidating ahead of the FOMC meeting this week, right? 50-day moving average is your key support. HSCI remains in a downward bias, hugging very tightly the lower Bollinger Band. Same for HSI also. In fact, for the HSI, it has also collapsed below the 50-day as well as 200-day moving average support levels. For the STI, it actually bounced up last Friday. This morning, it continued to bounce up also. Our view is that if it clears above your 3-2 psychological level, then we should jolly well, there's high odds of profits to be made if you trade the bounce. But if it breaks below the 3-1, then we remain bearish. For the Thai index, it has fallen through the 1,500 key support level. In fact, for Thailand, it's actually the first ASEAN economy to do a 25 basis points rate cut end of May, right? When other ASEAN economies such as Indonesia has actually hiked rates in other economies such as Malaysia has actually stood pat. For the Jakarta Composite Index, it's forming a temporary support at the 4,600 level. As we mentioned earlier on, it did a 25 basis points hike to the FASB, as well as policy rates during last week's monetary policy meeting. For the KLCI, it remains the most resilient ASEAN index to date, right? And it remains in consolidation mode. Key support level will actually be your 50-day moving average support level. With that, I'll pass on to Ken, who will take us through our stock picks.
Hi, this is Ken. So as you've seen, the STI has came down quite a bit. So what are the counters that we think is worth a look? First up, in the O&M sector, we have Keppel Corp. We are positive because of three reasons. First, robust outlook of the O&M. Second, order books have been strong. Year to date, the order books are 3.1 billion, which in this is quite near our full year forecast of 5+ billion. And third, why we like Keppel Corp is because of the strong track record, right? Compared to the Chinese and the Korean yachts, Keppel Corp remains one of the yachts with very good track record, and this allows Keppel Corp to continue having strong order book wins and also have good margins on their projects. Second, we are also positive on Singapore Exchange Limited. The target price is $8. This is based on a not yet a revised upward target price. And why we like it is because of the strong securities trading value that we have seen in recent times. The current SDAV is approximately 1.6 billion, which is much higher as compared to previous 1.2 to 1.4 levels. And second, we also like SGX because of strong derivatives. This largely come from three of the derivative contracts, namely the Nifty, the Nikkei, and also the China A50. Third, the reason why we like SGX is because of good dividend yield. This is approximately 4% at current prices. In the property sector, we like Hobby. Target price $2.52, and the closing of as of Friday was 191. And the reason why we like Hobby is mostly due to the potential strong valuation gains from the completion of Metropolis. This is expected to be approximately 500 million, which translates to approximately 60 cents per share. Fourth, in the consumer sector, we like Cots Asia. Target price 114, closing 0.945. Previously, Cots has risen to $1.17 before coming down in line with the STI. The reason why we like Cots Asia, three reasons. First, Indonesia expansion. Cots will be expanding into Indonesia, which provides a new market for them, on top of current markets Singapore and Malaysia. Second, strong consumer demand. In these three markets, we expect to see strong consumer demand, especially for electronic products, which Cots is dealing with. Third, Cots have a unique credit facility. They provide in-house credit to customers, and we expect this to attract more customers. In the telcos, we like Singtel, target price $4.07. The reason is because of its attractive dividends at 4.4%. Also, there is a lot of potential for growth through its overseas associates. This includes Telkomsel for Indonesia, and also in Thailand we have the AIS. Third, Singtel has resilient earnings. This can be seen by the marginal year-on-year growth over the last few years. And sixth, we like Pan United, which will be today's feature. Passing on to Joshua.
Good morning, everyone. Thanks for watching our webinar. I'll move straight into Pan United, which I cover. Okay, is it a good time to buy back into Pan United? Okay, so we've had a sell-off in the STI, so we have those 6 or 7 counters for our companies in focus, and today we're going to talk in more detail about Pan United. As you can see that in line with the sell-off, Pan United has also come off, and we actually think that at the present price, about 90.5 cents represents not a bad opportunity to buy into the stock. Okay, the main themes governing Pan United is that number one, it's Singapore's largest supplier of ready-mix concrete and cement actually as well, and this is a play on Singapore's infrastructure and housing boom. It also has a 51.3% ownership of a top 10 river port in China. The interesting thing about this is that Macquarie Infrastructure owns 38% of this port as well, and Pan United has a right of first refusal. And for those of you who are keeping up with corporate developments, Macquarie Infrastructure is in a strategic review right now, and it is disposing of all its assets. Okay, let's just start with basic building materials, which is 75% of profit before tax. Okay, there's a very strong visible pipeline of public works. We think till at least 2019 as Singapore struggles to close the infrastructure gap after a decade of population expansion. BBM commands 29% and 33% of cement and ready-mix concrete respectively, right? And this almost guarantees exposure to the construction boom. So why bet on an individual contractor when you can bet on a dominant supplier? It runs a full value chain for basic building materials. It has 2 granite quarries. It has a shipping fleet to transport the aggregate, and so even in a time of supply crunch for aggregate, it is much more nimble than other players in sourcing for aggregate from other parts of ASEAN, which it did in the last sand ban, if you recall. It was able to supply ready-mix concrete in it at the extremely high price during the ban and made quite a bit of money. Also, the shipping division is experiencing an earnings turnaround and currently contributes 9% to profit before tax. Okay, it also has a portside cement terminal in Jurong, warehousing network of production facilities and technical expertise for specialized concrete, and has a very strong record in the public and private sector projects. This year it has, for the major projects, we have the Singapore Power Cable Tunnels, Changi Terminal 4, Sports Hub, South Beach, and Marina 1. Next year, actually, we think that it will be an even better year because of the Thomson MRT line, which is an 18 billion project. East Regional MRT's North-South Expressway, which is 8 billion, and Sengkang General Community Hospitals, and the ongoing relocation of city port facilities to Tuas Megaport. So Tuas Megaport is an ongoing construction project. There's also a hefty amount of private residential units being built, 95,000, and about 7.1 thousand square meters of office shop floor and factory space. So here are the charts for that. The orange line on your top left chart shows Singapore's construction output, which is on a steady uptrend. The chart below that shows the 95,000 units which are under construction or unstarted in the residential market. And the chart on your bottom right, the blue line shows the over 7,000 square meters of supply an office shop and factory space that is in the pipeline. Okay, so for the top panel shows the segmental earnings for BBM, and we're forecasting a 5% increase in earnings this year and then 8.5% next year, as 2014, as we mentioned, is the year when more large projects kick in. For shipping, we have an earnings turnaround. If you look at 2012, there's an operating earnings of 3.1 million. That is actually from just one quarter alone. So our estimate of 6.9 million this year could actually be on the low side, but we're being conservative here. Okay, let's move on to the port and logistics segment, which drives 19% of profit before tax. And has some interesting features to note. Just to recap the background of this port, it's 51.3% owned by Pan United. It's a multi-purpose river port with logs, paper and pulp, steel, containers, general cargo, and general warehousing. It's got an extremely good location, serving the having a captive audience for the Suzhou, Wuxi, and Changshu industrial area, which is about 20% of China's GDP, and it's got a good depth of 13.3 meters, which can take up to 100,000 deadweight ton. So for a river port, it's got it can take sizable vessels. It's got a reasonably long berth length of 1.7 km, and of note, it's got 1 million square meters of land. And so that's a lot of land that it can utilize to expand the capacity of the port. Currently, it has over 100,000 square meters of warehousing space and 600 over 1,000 square meters of yard space. Okay, so it has quite a bit of capacity expansion space that it can utilize as the region grows. Now, interestingly, Macquarie Infrastructure Fund owns 38% of CXP, and MIIF is in the process of liquidating its assets. So recently it monetized Taiwan Broadband Communications for a price of 510 million, which is slightly above net book value, and CXP is the next asset in line to be liquidated. So it has been already stated in MIIF's strategic review somewhere, I think at the beginning of the year, that it will be liquidating all its assets. So to note is that Pan United has the right of first refusal for this 38% stake, which puts it in the running to actually buy it. Okay, pricing will be the key issue, and judging from the Taiwan Broadband Communications case, MIIF could ask for something around the net book value of 106.6 million. Apparently, currently Pan United has 98 million in cash and 72 million in debt, and equity of 375 million. So it can drain the cash to buy the asset and gear up a little bit more. From that, we think equity raising is actually unlikely. So during a management briefing, we asked them what is the odds of a rights issue or an equity issue that could be dilutive to earnings, and their reply was simply that they have the cash. We think that the odds of a equity raising is pretty low. Okay. The two panels here, there's a before and after. So if you look at the left one, the red circle, this is our projection of the earnings this year, which is about 9 million. If they buy the 38% stake, you'll be adding about 7 million to the bottom line. Okay, our current forecasts, however, do not factor in this acquisition, and current earnings per share forecast is 8.6 cents, as you can see here. Okay, because there's a likelihood that the acquisition may not go through for whatever reason. I mean, in the end, Pan United could decide that it does not want to buy the 38% stake. Then, of course, this event would be off. But in the event that it did buy, and we think the likelihood is quite compelling, we could see earnings per share rise by just over half a cent to 9.2 cents for this year. And then for 2014, you could add another half cent, so a full 1 cent to earnings per share could be added in the event they buy the 38% stake. And so because we're already halfway through the year, if they buy it now, then you would only be booking in 6 months of earnings. However, next year you'll be booking in the full year in the event that it does happen. So Pan United's management has a solid track record of value creation. So the other possibility is that if Macquarie Infrastructure wants to sell their 38% stake at a highly inflated price and there is a buyer, Pan United could actually sell it on with them. So these are the options available, and it's a possible catalytic event in our opinion. Okay, so we've come to the end of our presentation, and if you guys have any questions, please feel free to ask them now.
Hi, this is Ken. There's a question on with regards to the stock picks. So moving back to the slide on stock picks. Okay. The question would be what would be our time frame for the target price of our stock picks? For this, our typical target price is set on a 1-year horizon, but in the short term, we expect these stock picks for them to outperform the STI index. To reach the target prices, likely we will need for a rebound in the STI.
So with regard to the question, let me repeat the question. Based on what is discussed, does it mean that if STI level is above 3.2 will be bullish, below 3.1 will be bearish? I think the short answer to that is yes, because as we have shown in the STI chart just now, 3.1 forms your near-term support and 3.2 is your psychological resistance. So in fact, at this juncture, STI is bouncing up, but he has yet to actually clear decisively above the 3.2 level. And if right, all right, let me repeat the question again. So the question essentially is whether will we be bullish if you're above 3.2 and will we be bearish if you are below 3.1? I guess from what we saw in the STI chart just now, from a trading perspective, what we're seeing is that 3.1 is forming a near-term support for the STI. Notwithstanding the bounce this morning, the STI has yet to clear above the 3,200 psychological resistance. And once if it decisively clears above that, we look to actually trade the bounce. Thanks.
Hi, question on Pan United. So does Pan United have a dividend payout policy? Yes, it's oh no, it doesn't have a fixed dividend payout policy, but it has a very good track record of paying out dividends. So the average payout ratio goes between 40 to 50% of earnings are paid out Okay, so it's 4 cents of earnings was paid out for 2012, and we think that will be maintained this year and possibly raised to 4.5 next year. Okay, so Panyu has a very good track record of paying dividends. The other question is, what's the value of CXP carried on Pan United's books? Actually, it's a bit understated on Pan United. So the net book value is about 90 to 100 mil, and but I think it's actually probably worth about 150, going by how MIF has valued theirs. Okay. Okay. Moving on to the next question.
Okay, there's a question on our views on Sembcorp and Marine with comparison to Keppel Corp. Currently, our stand is still we prefer Keppel Corp. We prefer Keppel Corp over Marine. Why? Because of the margin outlook. Keppel Corp has more upside to margin surprise, especially for this year because of the record delivery that Keppel Corp is going to deliver, with mostly their proprietary jack-up rig design, KFL B class. This, we think, because of this, there will be upside margin surprise because revenue recognition is always recognized at the back end. So with regards to Marine, because of the fact that they will still have to incur tuition learning fees for their drill ship, for their 7th drill ship, and this is like a new product for them, so definitely there will be some tuition fees in the near term for at least a few quarters. That's what we are seeing currently. And not forget, Keppel Corp at this current price, there is a attractive dividend of 4 to 5%. So what we think is Keppel Corp is still a good bet currently. Questions?
Hi, here's a question on whether it's time to start bottom picking for stocks in general, like PanU, because for most stocks, there's a lot of technical support levels have been breached. Okay, so now as Waywen has mentioned just now, that the STI has done a bounce. Okay, so we don't exactly know when will all this selling end. However, we still do feel that this is the year for stocks, and principally because in a monetary tightening situation right now, actually the outlook for bonds looks much worse than for stocks. I mean, if Ben Bernanke withdraws quantitative easing support for bonds, there's going to be a lot of selling of bonds. And that also signals that the economy is getting better, which means you should be investing in stocks. So although we have a weakness in equity markets now, eventually we think that it will give way to a rally. And it's actually quite good if the Fed continues to signal now that it intends to withdraw QE, then all that downside would have been priced in, and we may actually have a rally eventually. So currently we still view that the bull market is still on, and that this is a short-term correction. Okay, we have no more questions. Then we can wrap up this week's webinar. Thank you all for attending, and hope to that you all will attend again next week. Thank you.